And welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. It's jobs day in the US, so really there's only one key focal point for traders today, and that is, of course, the jobs report. Just to quickly touch on the markets, we are seeing European equity markets trading a little bit higher, actually. We're around 1% higher on the FTSE, almost 2% higher on the CAC and the DAX, and then around 2 to 3.5% higher on the Italian FTSE MIB and the Spanish IBEX. Again, I do still think this is not necessarily a reflection of a more bullish sentiment in the markets. I don't think we are seeing an improved outlook here. I do just think what we're effectively seeing is a bounce from the losses at the start of the week. We are still down on the week here, and I think that's important to note. We're just seeing a lot of volatility in the markets right now. There's a lot of uncertainty, and maybe that's not quite filtering through into outright negativity at this moment in time, which is why we're seeing these big swings. But I do still think the overall sentiment, the overall tone in the market is a negative one, and today just reflects a bounce in sentiment rather than anything more substantial. We are seeing banks, for example, trading a little bit higher today, even in Italy, and I certainly don't think sentiment around the banking system in Italy has improved. We're seeing oil trading higher, which is potentially helping to lift sentiment. This has been potentially supported by the smaller than expected drawdown in crude oil inventories yesterday evening, which again is, like I say, which is helping to lift oil and therefore potentially helping to lift a little bit of risk appetite as well. But as I say, I think the main moves that we're seeing today the main story today is still focused around the US. We're having a day effectively off of Brexit and Italian banks, and focusing primarily on the US. Now, it's worth noting that this US jobs report today, I don't think it was going to directly have much of an impact on the near-term outlook for Federal Reserve interest rate hikes. A simple fact being that the Brexit is the main risk to US interest rates movements right now, and until the Fed is confident that the implications of a Brexit isn't going to negatively impact the US economy or have a significant impact on financial markets that could impact the US recovery, I do think they are just going to hold pat. So I think really we're looking at the end of the year at the earliest at this stage before we see it, and even then I think we're going to have to see strong jobs reports between now and then. We're going to have to see settled markets. We're going to have to see a minor reaction, well, not necessarily a minor reaction, but we're going to have to avoid seeing a big reaction to the UK vote. If we are going to see a rate hike at the end of this year, we're going to have to see wage growth as well, I think, just to give the Federal Reserve that little bit of extra comfort. The jobs report today was good in some ways and disappointing in others. You can see from the data right now, 287,000 jobs added was a very strong figure, well ahead of expectations, which gave the markets an initial boost. It is worth noting that the previous figure was revised down from 38,000 to 11,000. The April number revised slightly higher, they're offsetting really the decline that we saw in the May revision. But overall, looking across the last 3 months, we're seeing just under 150,000 jobs added each month. I think that is going to be enough for the Fed to warrant further rate hikes further down the road. Had we not seen Brexit, I do think July would now be on the table, but that is not the case. In other parts of the report, we saw unemployment jump from 4.7% to 4.9%. Nothing to be concerned about here. Part of this was driven by the increase in the participation rate, which is a positive thing. Overall, it just reflects negatively in the unemployment rate, as it did in the opposite way. Last month, we saw the unemployment rate fall from 5% last month to 4.7% as a result, partly of the drop in the participation rate. We've seen the opposite today. But what it does mean is in the last 2 months, we have seen the unemployment rate drop from 5% to 4.9%. So overall, that is quite positive. Average hourly earnings disappointed, 0.1% instead of 0.2%, but then year-on-year figure up to 2.6 is a little bit positive. So quite a mixed report here. We did see a lot of volatility in the markets off the back of this. We saw some initial strength in the dollar because of that strong non-farm payrolls figure. We then did see that reversed, and eventually we have stabilised pretty much around the opening levels. And I think that really does just reflect the fact that the markets have looked at this report and really thought it doesn't really change anything in the longer run. The near-term outlook for interest rate hikes is unchanged. We're not expecting anything different. and maybe we'll start to readdress this by the end of the year. But overall, bit of volatility around this number. This is the only real key event that we've got today. Looks like we're going to end the week on a high in the markets overall, and really another volatile week, and I do expect this to continue in the coming weeks in the markets. For more in-depth news and analysis, check out OANDA MarketPulse at MarketPulse.com. You can also find out more about OANDA and sign up for a free demo account at OANDA.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.
Yeah, the issue is not